Here is an overview of how money can be embezzled from an association by hiding and moving the missing money through various accounts, like the famous shell game, until finally it's gone. The accounting techniques utilized are ingenious, slowly hiding the missing funds over several years. The alleged scheme involved federal income tax fraud and criminal embezzlement, required coordination between several entities, including a CPA, a association board of directors president, and a property manager, all working together to cover up the alleged crime. The identities of the parties involved are not named here. While the initial issues began in 2015, today in 2020, members of the association board of directors are involved and actively and knowingly engaged in covering up traces of the alleged criminality shown here. The alleged crime was quite simple. Remove $140,000 from the association accounts while hiding the missing funds so it was very hard to detect in the financial reports. Over the next few minutes, as we move through the paper trail, watch the missing $140,000, which is moved around over a period of time, making it practically invisible. A warning to our viewers: a basic understanding of accounting may help to follow the missing $140,000 as it is moved from account to account. This report begins the scheme. It is showing a revenue account called Developer Contribution, listing bank deposits during a single fiscal year. The deposits shown, $175,000, were apparently only recorded in association QuickBook records, but never deposited in the bank. The allegations of embezzlement are based on this money that apparently was never deposited in the bank accounts as shown in the report. This created a problem because reconciling the bank accounts would not be possible. This scheme is how this problem was overcome, mostly over a 2-day period, using the IRS tax returns as a second set of falsified books to hide the alleged embezzlement. Here we see the profit and loss statement on the last day of the fiscal year before tampering. Is based on real expenses and real revenue, except the revenue is overstated by the missing $140,000 because the reported deposits do not exist. This is the second page of the same profit and loss statement, showing expenses of $788,000 and a loss of $16,000. The $788,000 expenses are based on real expense numbers. The $16,000 net loss included the reported but missing $140,000. This means without the reported but missing cash, the real net income was $140,000 lower than what is shown here. On day one of the cover-up, which is the final day of the fiscal year, the accountant makes a number of journal entries shown here, roughly eliminating $140,000 of revenue and expenses. The reduction is part of the scheme and does not represent real expenses or revenue. In other words, the entries eliminate real revenue and real expenses from our books. Here is the profit and loss later that same day, after the fraudulent journal entries. Watch closely, because this is where the magic begins. Watch several key numbers. First, the goal was to keep the account 4021 developer contribution showing a big deposit, even though the money was never deposited. So it still shows $140,000. Second, our revenue has decreased from $771,000 to $628,000, a decrease of $143,000. Here, on the second page of the same profit and loss, our expenses decrease to $623,000 from the previous $768,000. A reduction of $145,000. And finally, our net profit is now $5,000 positive compared to the previous $15,000 loss. So what's been done so far is that we have eliminated $140,000 of revenue and expenses and placed $140,000 into the developer contribution deposit account, making it look like the $140,000 in developer contribution deposits were actually made. Here's our balance sheet at the same point, showing a negative retained earnings of $188,000, which is close to the previous year. Later, that same busy day, the federal tax returns are prepared and include very different numbers than our accounting records. First, the IRS revenue is reported at $486,000, not the $623,000, which is $140,000 below our profit and loss revenue following the fake journal entries. And second, expenses are reported at $623,000, which is the amount after the falsified journal entries. This creates a loss of $133,000 compared to the reported $5,000 profit that followed the falsified journal entries. Here is page 2 of the same tax return, Schedule L. We see the new $133,000 loss added to the previous retained earnings for a total of $321,000 negative in retained earnings. So let's summarize what the fraudulent IRS tax returns accomplished. First, by understating actual revenue by $140,000, we report an additional $140,000 in loss. While the association operates as a nonprofit, it does report income in excess of $30,000 annually. So potentially, the association committed tax fraud, reducing taxes owed. Secondly, the association is hiding a loss caused by money embezzled from bank accounts on falsified federal income tax returns, which is probably not a best practice. Day 2 of our scheme, which is the first day of the next fiscal year, the balance sheet shows retained earnings of $183,000 negative, not the $321,000 loss shown on the IRS tax returns. So what was done was the missing deposits of $140,000 were converted into a loss only appearing on federal tax returns. The developer contribution shows $140,000 in deposits that never happened in the year-end financial statements. An accounting magic trick. The year-end close is run, which zeroes out all revenue and expense accounts. So the year-end financial reports show the $140,000 of contribution deposits that never happened, and the lost money is hidden on the IRS returns by the year-end zero out, and the balance sheet looks okay. The only problem is that the IRS returns and the association's books are off by $140,000. The IRS returns become a second set of books hiding the embezzled loss. Later, that same day 2, these journal entries are entered, returning the revenue and expenses to the books on the first day of our fiscal year. None of the revenue or expenses are real. At this point, on day 1 of fiscal year 2016, the alleged conspirators leave everything without any further detected tampering for the remaining 364 days of the fiscal year, probably to ensure nobody questioned any of the alleged malfeasance. Accounting records appear in balance and close to reality. The undeposited $140,000 shows up as deposits on year-end statements where none were made, and the only evidence of the crime is that the retained earnings reported to the IRS and the balance sheet are off by $140,000. Here we show a negative $183,000 in retained earnings, while on our IRS returns we show negative $321,000. A year later, on the first day of the following fiscal year, or the third fiscal year of tampering, nobody has seen the missing money, and it's time for additional cleanup. In this set of journal entries, the association finally recognizes the $140,000 loss by increasing retained earnings, so now it ties to the IRS tax returns, and the journal entries offset that additional loss with a loan payable to unknown. No documentation ever existed regarding the mystery loan. Finally, here we see our new balance sheet with the increased loss resulting from the $140,000 that has been embezzled from association members. 2020, association members find the alleged crime and report it to the association, demanding an investigation of the missing money. No response is ever received from the association. Within several months, association property manager, with no involvement of the board of directors, performs a write-off of the $140,000 mystery loan to complete the alleged embezzlement and cover-up activities. Here, association members question property manager and association counsel about the write-off, which some consider an attempt to cover up the alleged criminality. No answers are given, the missing member money is gone, and all traces of the alleged crime disappear with the exception of this report. Association member questions management and the board of directors about allegations of embezzled association money. Detailed accounting records indicate falsified bank deposits resulting in negative retained earnings on association books that get converted to a loan payable and finally written off by manager Larkin without any audit in violation of various federal laws, including felony criminal embezzlement and tax fraud. Specifically, my question to you, Mr. Larkin, is, having received the letter about the possibility that that $140,000 was used as a vehicle to cover up a theft from association members, what did you do to make sure that that was completely cleaned up before you unilaterally, without the board, wrote it off? Because the auditor did not authorize you to write that off. You did it all by yourself, only with consultation with the developer or the former defendant, the developer. There was no involvement of the auditor in that decision, none whatsoever. So what did you do related to the letter about the fraud and the embezzlement that involved that same loan before you did the write-off? Manager Larkin represents the developer's real estate interests for nearly 100 properties and is widely believed to have a conflict of interest. Here, Manager Larkin, CEO of NAI Miami, indicates confusion about accounting principles when questioned about the write-off he conducted without any board approval that eliminated the loan used to cover up alleged embezzlement by his client.
Okay. Could you please connect how writing off an obligation of the association so they no longer owe $140,000 on their financial statements relates to the balance of your query?
It was very clear.
The balance of your query can continue to be investigated. No one's stopping anyone from investigating it.
The relationship is direct transactions, journal entries in our accounting system that you have in your possession that terminated with that loan. Yeah, they're in the letter that I sent to you in April. I can send it to you again, but so without.
No, you don't have to.
Okay. Well, you were given the accounting transactions that connected that $140,000 loan. Association General Counsel Rogel, who was disqualified as association litigation counsel due to conflicts of interest, here advises board members and management to refuse to answer questions asked by an association member during a board of directors meeting. The same questions asked in writing or as part of official record requests are responded to in a similar fashion. We, the association, refuse to reply to member inquiries.
I'm gonna recommend that the board members who, to John is trying to put words in their mouth, simply refuse to answer those questions.
Association member questioning the failure to perform audits as required by Florida statute during the period where the alleged criminal embezzlement occurred, and requests that the board conduct audits to comply with the law. Association Attorney Rogel states that there is no interest in conducting audits related to the alleged embezzlement. The last question I have is, there are no audits for the period in which this alleged fraud occurred. I believe that it's a requirement of the Florida statute that we have audits. In consideration of the fact that there have been allegations that have been very carefully documented of fraud, and there have been no audits at all for the periods in which it occurred, could I request that the board move that audits be conducted for this period where the alleged fraud occurred?
You can request. I'm suggesting that you just requested. Does anybody want to do that? No. Okay, moving on.
Association member asking about current litigation where the developer CPA that conducted the alleged fraudulent accounting is currently suing the association for non-payment of accounting records that occurred during the alleged fraud. The taxes were clearly fraudulent. They are totally out of, they're not consistent with the books at all. And he's the individual that signed and prepared the taxes. They're off by over $150,000, actually $140,000 off. And he prepared them. So why are we obligated to pay somebody? We have fraudulently filed tax returns. They're not consistent with our books, filed by this accountant that's suing us. Why do we have the obligation to pay him? Attorney Rogel advising that if the CPA was involved in the fraud, it would have required participation by a member of the board. He goes on to advise the board to pay the CPA and put the matter of criminal embezzlement and falsified IRS tax returns behind us.
So I don't know if John's characterization of him filing a fraudulent tax report is correct. Obviously, well, I shouldn't say obviously. Normally, when an accountant prepares and files tax returns for a client, they obtain some authorization from the client before filing the return.
Association President Posada is consistent in acting and voting to protect the developer's interests rather than the association members. President Posada consistently voted against any litigation, voted to stop litigation, acted to delay payment to litigation counsel, refused to speak with the official association legal committee, actively prevented the legal committee from participating during board meetings. 100% of President Posada's votes in matters related to litigation reflect the interest of the developer and not the association. He was elected with 76 votes from the developer and has confirmed a commercial relationship with the developer. Here, President Posada is confirming that he wants to pay off the CPA that committed the alleged criminal embezzlement and prepared the falsified tax returns to, quote, put this behind us. For the record, the motion to write off the questioned $140,000 loan passed with President Posada's yes vote, along with one other yes vote, for a total of 2 yes votes to write off the loan out of 5 board member votes. 2 yes, 2 abstain, 1 no.
Why do you guys think we should go ahead and pay? Because what he said to me is that he got all the emails and everything from board members asking him to do the job. Now, Jeremy confirmed. Yeah, we just pay him and move forward.
The association board and management have refused to respond to valid record requests, refused to answer questions about association money presented in writing, and refuse to respond to member inquiries in official board of directors meetings. Based on experience with many boards, this is not believed to represent appropriate conduct for any organization or board.